Money Radio for a really great future. We're talking real money.
We talk a lot on Talking Real Money about getting to retirement and how you generate the income you need in retirement to enjoy your life. And we are big believers in spending your money for you. You worked hard for it. You should use it for you. If you have some left over, you leave it to the kids or charity. That's awesome, but that should not be your primary goal unless, and of course I have to throw this in for the not serious, for the people who are too serious in our audience, unless you have a special needs person in your life for whom you should have established a trust and take care of. But otherwise, your kids, your adult kids who are working and living independent lives do not need an inheritance and don't need your estate or your house. And there's a reason why I mention house. That's going to be the topic of today's episode of Talking Real Money. Hello, I am Don McDonald, one of your two hosts. Right there in the brown shirt, Tom Cock, the other host. And welcome to the program.
Is that welcome to me? Thank you.
I
appreciate it.
Welcoming you, brown
good
shirt.
to be on. Good to be heard. Yeah. Well, trying to shake things up a little bit. It's always been blue or white or something.
You're not looking very corporate in that.
I don't think it
You
does.
would not fit in at dimensional funds at all.
No, they would look at that and go, what?
What? Are you wearing a color? No,
Don't
at
do
DFA
that
it's
again.
all white. They are
It is.
though. They are the
I know.
white shirt.
The last people in America still wearing white shirts.
I mean, my gosh, it looks like an episode of Mad Men. Although I'm sure
Let's
they're
not
less
go there.
sexist.
And
I'm
less
sorry.
booze and less cigarettes,
Less
too,
booze,
I believe.
no cigarettes. It's
okay.
funny. I'm rewatching Mad Men because Debbie never watched it. I watched it on and off by myself.
Love it.
And I said, you're going to love this show. And she does, by the way, because it's so brilliantly written.
It's awesome.
But we used to smoke a lot, and I forgot how much we used to smoke.
And it wasn't that long ago. I mean, that was a long time ago. But
dude.
my father in 1985 decided he was running a U.S. Air Force hospital that there be no smoking in the hospital anymore. And he got fired for doing that.
In the hospital.
1985.
I know,
It's
smoking in the hospital.
In the
But I
hospital.
remember visiting my grandmother in the hospital, and we smoked. And she had emphysema.
Light one up. Light one up. Sure, why not? Grandma loves that.
We smoked in
Can't
the grocery
breathe, but,
store.
I know.
We
It's hard
smoked
to
in the
believe.
movie theater. We smoked on the bloody airplane. And there was like
Big time.
the smoking section in
Yeah.
the back and the non-smoking section.
Oh, that works.
As if there is some invisible wall that keeps the smoke from getting to that row in front.
You got a fan or something that's going to blow it back on those people?
And I think about this a lot. This is a financial thing. Part of the reason we had homeowners insurance was to protect us from burning our own houses down because we
And
smoked
people
in
did
them.
that. Sure.
All the time. They would fall asleep with a cigarette and their house would
Yep,
burn down.
sure.
Nowadays, maybe we don't need it as much because we don't smoke. When was
There's
the last
far
time you
fewer
went into
people
somebody's
smoking.
house that smelled like smoke?
I couldn't tell you that because anytime you even smell a person now that smells
like
like smoke, it's such
outside.
an anomaly. It's such an anomaly. And Seattle, you can't, there's nowhere to even smoke, I think, if you wanted to. I don't think there's an area anymore where you can go. Remember in the old day, when this was all changing, you used to have the little smoking place outside
Right
the
outside
building,
the
whatever.
front door.
I don't think you can do that anymore either.
Well,
I don't know.
I noticed at Disney, there's no smoking in the parks. People are
Period.
They're smoking when you walk outside the park. You'll occasionally, like in the pre-ticket area, catch the whiff, and you go, and they may be like 100 feet away, and you're going, oh my
What is
God,
that?
that's disgusting.
Yeah, it's crazy.
Anyway.
Yeah, and by the way, for those of you who want to visit Disney but don't actually want to go in the park, to go in the pre-area where you can smoke is only $120 a day. So that's the cheap part. I recommend
Right,
it.
it's $200 to go into the
You
park.
can see the park from where you are. You don't actually go in. Plus, you can smoke.
He's lying.
So it's a pretty good deal.
He's lying. He lied. Just so you know, because he sounds convincing. So
I'll
it's a lie.
get the cards and letters
You're
on that.
going to get
one,
another
too,
nasty gram from Disney Files.
Count me in. Okay. fair
Anyway,
enough.
we're going to talk a little bit about another source of income in retirement, particularly if your goal is not to leave stuff to your kids. And let me tell you, if you're still in the big family house, like we are, for like 30 years.
Well, we're not big anymore, but have
Yeah.
a lot of equity.
But no, but the big family house, the one, your kids don't want the big family house.
Nobody does.
They don't want it. If they
You
got
old boomer?
it, they'd sell it and get something smaller.
Yep.
So the reason I mention this is because today, reverse mortgages are
Click.
not as scary as they used to be.
Click. There goes the show. Because once you say it, people are like, those are so shady. Reverse mortgage. That's the slick guy in the green suit telling you why you got to have this now because you don't have to pay on your mortgage anymore. It costs almost nothing. And look at all that money you can access. You could go to Disneyland with that, or Disney World, pardon me, with that money. And by the way, do you know how much is in home equity in the United States of America right now? I just looked this up.
A lot.
Okay. A lot. 35 trillion.
Wow.
With a T dollars, all locked up in these homes. And so, this is an area where if you're heading into retirement and you may be short on cash, liquidity, this is another reason we say don't run out and pay down that mortgage, especially when it's 2.5%, because you can't get at it. Well, there's a way to get at it, I guess, right?
Reverse mortgage, one of the most attractive things about it is not even the cash you take out. It's the fact that if you still have a mortgage on your home for which you're paying $1,000 or $2,000 or $3,000 a month, $3,000 if you have an expensive house, you can pay that off with the reverse mortgage and
you pay it
nothing.
off and you don't have to pay anything.
You don't have to pay a
monthly.
penny. You can live in your house and not pay anything, even if you don't take money out.
Taxes
Property
and insurance,
taxes, right?
And insurance.
Right.
Other than that, it's all gone. But you're the one who found this piece
from Money Magazine. I was
Money Magazine. That's right. The myths of reverse mortgages, and I mentioned the first one already. They're shady, which is they earn that rep.
They used to be very shady.
Right.
You had a lot of has-been stars on TV pitching reverse mortgages to unsuspecting seniors, and those unsuspecting seniors were getting locked into things that were horrible deals, lots of high fees.
Yep.
They in essence, and some of them lost their house in a very short time because they were so shady. But today they're all regulated by FHA.
Yeah, which was not the case, right? This was just a cottage industry that popped up. So that's one. Then the second one, which is kind of an interesting thing because I've said this fairly recently, the myth that reverse mortgages are a last resort. In other words, you don't have enough to pay the bills anymore. You're in retirement. You've used up your assets. You're living on Social Security and you have nothing else. This is a last resort. And they're arguing that's not true.
Well, think about it for a minute, because our argument is we want you to spend your money to enjoy your retirement. And if by getting a reverse mortgage, you can reduce your cost of living by $2,000 or $1,500 a month, that gives you money that you can use to live more comfortably, not to improve your lifestyle, not just to stay alive. It doesn't have to just be an existence thing. It can be a fun thing.
That's why I want you to call 1-800-HOME-EQUITY now. No, kidding.
See, now, once again, somebody's going to call that.
They probably
because
will.
they think
so
they trust you, and they should learn not to.
They're shady. Number two, they're a last resort. Okay, here's one. Now, here's one that really requires some research, and I know you did it. Mm-hmm. The number 3 myth, according to Money Magazine, about reverse mortgages is they are expensive. Can you dispel that?
They're not cheap.
No, they're not inexpensive.
They're
either,
not
by
inexpensive
the way.
because, well, they need some things. One, they need some insurance to protect their investment. Because remember, these are investors who are hoping for a payoff down the road when the property gets sold. They're going to get a stated interest rate on the money they put up front. They have to make money on it. Somebody has to make money on these things. It's not
they're not going to come up with the cash.
They're not going to come up with the cash. So there is an origination fee, but in the past, these origination fees could run 5 figures. They could be
what
very
percent?
Well, the origination fee is maxed at $6,000. Depending on the, it fluctuates between, I believe it was 4 and 6.
And did you tell me there was a cap as to the value of a house?
Yeah, I'll get to that in a minute. I'll get to that. The fees are the up to $6,000 in
That's to get going. That's the
to get going.
origination
That's just
fee.
to get all the paperwork going.
Yep.
The closing costs run about $4,000 to $6,000. That's the appraisal and the title.
1,000 or percent?
$4,000 to $6,000.
Okay.
That's
so
not
now
terrible.
We're at somewhere around 10.
Right. 10 to 12.
Okay.
Max. Max. That's 10 to 12. Pretty much max.
Period.
And then there is a 2% FHA mortgage insurance fee.
Of the value of the home?
Of the value of the note.
The note. How much they're loaning you to pay off your mortgage and go to Hawaii.
So,
pardon me, Disney World.
The largest value they will lend against in a house is $1.2 million.
1.2 million is the max, and there's only a percentage of that of which you can borrow.
Correct.
I think it's 40% or 50 or something.
I have so many notes here. My notes are like pages
I remember
long.
looking that up, and it was something in that area. So there's a limitation to all this. It's not going to be panacea, but it could be helpful in terms of your overall income needs.
Yeah. So let's see. That's 1.2 million, and I just. Oh, it's 0.58%. It depends on your age. It's somewhere between 0.4 and 0.6% of the house, or between 40% and 60% of the value of the 1.2 million max. But it really depends on the value of your house. So we're getting into the weeds a little bit, but it's only a percentage.
But I want to make clear, okay,
it's only a percentage that you could borrow. And then there are some ongoing fees. You've got like 0.5% every year for the ongoing mortgage insurance
on the note,
but none of this accrues.
No,
I mean none of this is payable immediately. It all accrues
at the end of the deal. We'll get to that in a minute. So is your read then looking at those fees that it would be? In my mind, it's not expensive. Depends on certainly the value of your home, but it's not expensive. But it's not inexpensive.
No,
either.
It has to be part of a plan. Like everything else, it has to be part of a long-term plan, because now you got to amortize those upfront costs over your savings. Because let's say you're saving $2,000 a month, and you hand over, let's say you're getting like $400,000. You're going to pay about $35,000 in upfront fees. So that means you're not going to be at break even for 3 years. You're not going to make back.
35 on 400 is almost 10%.
Yeah, it is because of the origination fee and the closing costs.
That's what I'm getting at. I mean, so again, it's
not cheap, but it's better than it used to be. And if you're going into retirement, you go, I'm on the ragged edge. I'd like to have an extra $2,000 a month or whatever the amount is. If you're in your 60s and you plan to live into your 80s, then this could be a very good deal. You're gonna have an upfront cost that's gonna hurt right now, but you'll make that back over time, and then you don't have to worry about it until you either sell the house or die.
Yeah, we'll get to that in a minute. But okay, so you would both do. It would be two things. You could get cash, which could supplement your income, and you reduce your outflow because you're no longer paying the mortgage anymore.
Right. Yeah. You can either just pay off the mortgage, or you can pay off the mortgage and take some cash if you're under the limits. Yes.
Yeah. I have no idea how popular, if this has gotten more popular.
They've gotten more popular lately.
Okay. All right.
Because
let's go through these
the
other
protections.
Myths. Yeah. Let's go. So the number one, again, was they're shady. Number two, they're last resort. Number three, expensive. Number four, which is an important one, because most people, if you tell them reverse mortgage, they still believe this. Your heirs will not inherit your home.
Not true. They will still inherit the home. There's just a note that now has to be paid off, just like your mortgage. As it would
be for many.
Like if the mortgage was still there.
Indeed.
They would have to pay that off. There's still a mortgage that has to be paid off. If there's equity over and above whatever that amortized cost is, per the amortization schedule, it's written down, then the heirs get that money.
Yeah. And which brings me to number five. The myth was you won't own your home anymore. Yeah, you still own your home. You just owe something on it.
I own my home. I have a mortgage. You
Me too.
own your home.
Yeah.
You have
Yeah.
a mortgage.
I do.
We still own the home. It's called a reverse mortgage. The reason it's a reverse mortgage is because there's no payment due every month.
Yeah. And here's something to think about, by the way, when it comes to this. For people that are, I don't want to single anybody out, but I know people that have gotten a later start in life. They haven't really saved. And I always thought, and I know it doesn't appreciate the way stocks do, but if you have a real estate and you're paying into it every month, right? You got a mortgage. It's for savings in a way, right? In a way, because you're paying the note down, even if it's slowly. The appreciation is there so that when you get to your 60s, now you have an asset. You got something. It might not be huge, but it's something. In this case, you could do, as we said, you could get rid of your housing payment and at the same time, you could get some cash. So it's a kind of a forced savings in terms of real estate. And I'd prefer, by the way, to see you get a good income, save a bunch of that in your 401k, Roth IRA, et cetera, rather than just think a home's going to be a panacea for your future. I'll put it that way.
What this is, and again, it does come back to something akin to last resorts. Because what it is, it's not a great way to make money. You're not making any money. It's costing you. What it is you're regaining liquidity without losing the roof over your head.
I think that's exactly right. So again, it always goes back to, and you mentioned this briefly, which I was surprised wasn't the number one word for 2025. Having a plan, because if you have a plan, then you say this is how it could work as part of that plan, right? Oh, and it's there. It could be available to do it. There's another thing that comes out of all this that I think is really important. $35 million, for the most part, locked up in home equity.
35.
It's another reason.
What'd you say?
I just said, did I say million? 35 trillion.
Trillion with
a
a
little
T.
difference there. Add a couple zeros. Is another reason not to be all anxious about paying off the mortgage. I got to pay off. Because you're putting money in there that's going to be harder to get at. Even these reverses, because there's even catches here with how much house you have and how much you can borrow, all that sort of thing. But I still think, as I have, this could be an important part of retirement for many people that are sort of what we call house rich and cash poor.
Now, there is another alternative that I didn't mention, but it is literally another alternative, and that is you got this big house, sell the big house, buy a smaller house for cash, or rent.
You're going to stay where you are, though, right?
Oh, Lord.
You can't move because it's the only place I know in Celebration. I never find you again.
It's so big. This was a house. This was a house for 2 adults, 4 children, and 2 dogs. And guests in the garage apartment because we live at Disney World. And what ends up at your house when you live at Disney World? Guests.
Yeah.
Because it's cheaper than a hotel.
Absolutely.
By a lot.
Yeah.
My son recently came. They live up in St. Augustine, and they brought the kids down to Disney. They surprised them, and they wanted to do the hotel experience. I'm going, Jake, we have a house. No, kid, we wanted to do the hotel experience.
Yeah.
And they wanted to do the Yacht and Beach Club because it has a great pool. It was $800 a night.
Yeah. I just did that a year ago when I was down to see you because they wanted to do the hotel experience.
Yeah.
And we had a room about the size of the studio for the 3 of us. It was pretty small.
What resort?
I can't even remember, but it was on the grounds of Disney. So you dropped me off there one night. So
I did? I don't remember.
Yeah. Yeah. Anyway, it was a year ago. I could see how you wouldn't remember that. So
My
sure.
God, I'm getting old.
But it was very small. And no offense to Disney, but the food was rather dismal in the place. So anyway.
Well, the only places where the food is really good are at the high-end hotels, which are getting up in the $1,000 a night range.
That I did. I don't think I paid that.
The Grand Floridian.
Nope.
Polynesian to some extent, contemporary to some extent.
Please don't say all those because my wife listens. Then she'll say next time we have to stay at the Grand Floridian.
That's where we got married.
Yeah,
the Grand Floridian.
That was 105 years ago, though. The place is quite different then. So,
actually,
all right, should we move on to questions?
The same.
Okay,
Here we go. There, Scott. Doesn't change it a bit.
All right, let's get some questions because Eric wrote from Grand Rapids, Michigan, home of former President
Gerald R. Ford.
That's right. His museum is there. I've been there. They even have the stairs he fell down on Air Force One.
That's hysterical.
Yeah, I think it's kind of weird. That's not
Chevy
a joke,
Chase
so don't write me about that.
Chevy Chase show up once in a while
who's
just
that
to
old guy
stumble
in the
down
back
them?
there? Shove him down the side. Eric said, I emailed you about moving my investment plan to basically 50% in DFAW, which is Dimensional's global portfolio, and 50% in a bond ladder. Well, I think I have about 65 bonds I'm juggling at the present time in our traditional IRA, soon to be converted to 403B. I work in college football, so you have to plan on being fired every year, even if you aren't. That's kind of a funny quote.
Yeah,
I'm assuming he's not a coach or something. I didn't look him up. He can't be a player because those guys never get fired.
No, he's probably an assistant coach or a trainer or
Yeah.
something like that.
You know the assistant coaches here at the University of Washington, you know how much they make? About $1 million a year.
Assistant coaches?
The assistant coaches. It's, big money. Anyway.
You picked the wrong football to be an expert in.
Exactly. I could be an assistant coach in that and make darn near nothing. He says, anywhere Roth IRAs and brokerage are now 100% DFAW and then 50% DFAW, and the mess of bonds is in the IRAs. So I looked into these iShare iBond ETFs, which is frankly what I do if I had 65 bonds, because that is a lot to keep track of.
Kidding.
If I made a ladder of those, it would seem to be much easier. Once a year, simply take the proceeds from the expiring ETF and buy another one.
Great
I'm doing
idea.
a 5-year bond ladder, so buy the 2031 symbol IBTK, and boom, done. See you in a year at Schwab. Am I missing anything?
Nope.
Or am I getting
Great idea. I really like
Yeah.
it. I
It's
really
easy.
like it.
So explain what that
Now you're
means.
going to get, but I mean, you have it with CDs. You've got these funds that will mature basically every year. You'll have a portion of them. The 1 year maturity of these funds.
Exactly.
They're
So when that
buying
comes
those
up, then
short-term
you gotta buy the
securities.
next one.
Now, if you want to sell it in the interim, you will have some fluctuation in net asset value in the price of the share.
Please remember that.
But doing it as a ladder, again, because it forces discipline, you have to agree to the discipline, though. That's one of the downsides of ladders, is that you have to, it's going to discipline you. You've got to do it. But what if you don't want to do it? What if you do the thing that a lot of people do, and the 1 year just came due, and you got to go out to 5, but rates are down, and you're going, well, I don't want to go in at lower rates. I think I'll wait till rates go back up, and then I'll get in.
Yeah.
If you break the ladder, then you've defeated the purpose.
Exactly. So in that case, it cleans it up because when it comes up, you just boom on to the next one. And this is, by the way, here's another idea. You could just buy a regular bond fund. Because they have various
but see, the
maturities
bond
in there.
fund takes away that feeling of certainty.
Yeah, I know. Yeah, because as you said, there's some fluctuation.
Yeah.
Anyway, speaking of bond funds, I know we touched on this briefly, but we'll do it again because Dustin from beautiful Phoenix, Arizona, which I wish I was there, says, hi, Tom and Don. Can you discuss on the show the new ETF offering BNDF that Vanguard is promoting by email? The email said BNDF can serve as the center place of your fixed income allocation. In this single ETF, you get broad exposure to the taxable fixed income market, including U.S. government bonds, investment grade, and high-yield corporate bonds, and emerging markets debt. Would this be a good substitute alternative to BND?
We've talked about this on another podcast.
We did.
And this is the land of Vanguard getting gimmicky. And it really bothers me because I think what you're doing is you're going from a fund BND, which is pretty darn secure.
And primarily U.S. government debt. They got a little bit of corporate in there.
Debt, but it's all high quality. It's all investment grade.
Yeah.
There's no.
They're adding.
I don't know why they add emerging markets bonds
because they want yield. They want to make more money.
It's yield enhancing.
Yep,
so to me, this
exactly.
is like the old government plus bond funds they used I used to
pitch.
sell.
Schwab had one that had a horrible time. I remember for a few years.
I hate
20
what
years ago.
Vanguard's doing right now. I really don't like the fact that they're pandering instead of leading. They are not leading, they're following. Instead of saying you should invest this way because it's the right way to invest, as they did under Jack Bogle, instead they're saying, what do you want? Oh, you want more yield? We'll give you more yield. There's more risk. Because anytime somebody says they're going to give you more money, there's going to be more risk.
I think I mentioned this last time we came up. Again, we look at fixed income as a place to conserve your money, keep your money, the ballast when things get bad. Everybody else running around saying you could make more on your bonds. Remember, there's two sides to that. You could, and you could lose more because emerging markets bonds, when things go bad for the world, that's going to be one of the places that gets downgraded absolutely 100% first. Right?
What they're doing
high yield bonds, same thing.
They're trying to compete with PIMCO. And PIMCO has a very compelling story that investment advice providers love, is that they can boost your yield in the bond side of the portfolio, which always works right up until it doesn't. This is the thing about gimmicks. They work until they don't, and so they can look back and go, look, this PIMCO fund has been making you lots more money. That's great. Remember how much more money you were making off collateralized mortgage obligations or collateralized debt obligations 20 and 30 years ago?
Yeah. And then
the bottom fell out.
Yeah, exactly. So again, and I don't see the need nor necessity of this fund either. It's a marketing tool
and I
to
say
get more
shame
attention.
on Vanguard.
Yeah.
I really do. I'm just saying it again. The whole idea of putting annuities into target date
401k
funds
plan or target date funds. Yeah,
you know, it's just gimmicks. They're trying to maintain relevancy, but they're still the largest mutual fund company in the world. How much bigger do you want to be? Bigger, I guess.
Yeah, I guess so. Speaking of bigger and better, guess what's coming up in just a couple months? And you can sign up right now. That's RetireMeet.
It's the same size, isn't it? It's not bigger.
I think the room is slightly larger this year in Seattle.
It's the same darn room.
No, they did something, made it bigger. I don't know.
They knocked a wall out in Maidenbauer?
I have no idea. Yeah, they're not allowing you and I to come in with a huge heads until right at the end.
What they did is they shrunk our little stage.
Probably. I hardly wait to see that. Yeah. Anyway,
we'll
be there.
3-foot square platform that we.
Don't tell Paul Merriman who will be there as well. Christine Benz will be there. Estate planning, Social Security, all the things you got to know about retirement. We've done this for, this is like 14 years or something.
Again, I've lost
This was
track.
Don's big idea, and you and your big ideas. Keep your mouth shut. So join us, and you can go to RetireMeet. Oh, it's March 7th, by the way. And you can, online or in person in Bellevue.
Yep.
I know a lot of you would love to vacation the Seattle area in March.
Everybody wants to be in Seattle in the winter.
Sign me up. Oh,
Huge.
There's
nothing like a nice cold drizzle. Oh,
just to cool you down a little bit from all that heat you've had
actually,
last
when you're
few
out
months.
in that nice cold drizzle, it makes you appreciate the warmth of the event itself. When you're inside having a nice Maidenbauer sandwich,
exactly,
and
which
not
are delicious
in the cold drizzle anymore.
Is this still the good sandwiches, or do you know if somebody from our company's in the back room making PB&Js?
I don't know.
I'm sorry. None of that would surprise me. Anyway, join us March 7th, online or in person, for RetireMeet 2026.
And if you have questions for us here on the podcast, we love taking your questions at talkingrealmoney.com on the contact form. You can type them in, and we'll read them just like we did a few minutes ago. Or you can speak them in, and I'll answer them on the Friday podcasts. Plus, there's always an opportunity to actually talk with a 100% fiduciary advisor who isn't going to try to sell you something, particularly not an indexed annuity. Just go to talkingrealmoney.com and click on the button that says Meet an Advisor, and you can meet an advisor for free. No obligation, no sales pitch. Easy. Anything else you want to add there, Mr.?
No, that is 110% it. That's all I got.
Mr. Formerly known as Cox.
Exactly. Let's move on. What do you say?
Okay. Thank you all. I appreciate you. I think Tom does too. And remember, almost every day, we do take Sundays off, but almost every day, we are here for you. Talking Real Money.
The opinions and views expressed on this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Wealth, a fee-only registered investment advisor. Please see Appella Wealth's ADV Part 2A on our website for information regarding Appella's fees and services. Appella Capital, LLC, DBA Appella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. And the lawyers get richer.